maintain that core stock bond profile that you really want, and the alternatives ultimately get layered on top. And so that's what we call return stacking, because it's ultimately this idea of stacking a second layer of returns on top of your core allocation. And it's something we're really excited and passionate about because it's a 40-year-old idea that's finally possible. And we think it truly unlocks the potential benefits of diversification.
All right, everybody, thanks for joining us today. I have Corey Hoffstein, who is co-founder and CIO of Newfound Research. He is also a mini celebrity on Twitter, Corey, you would say, I would imagine.
Mini celebrity.
And one of the nicest pirates that I know on YouTube. So, Corey, thanks for joining us today.
Thank you. That warm introduction, Chris. It's nice to be here.
Yeah. Are you wearing any other hats right now that I missed?
No, that's about it. I mean, janitor of my homestead, the usual.
Well, that's everybody's job. So
that's right.
Nothing out of the ordinary. All right. So I want to get into this paper that you wrote with Rodrigo and Adam Butler over at Resolve Asset Management. Almost, was it about a year ago at this point, or a little bit longer?
Well, probably 13 months ago. Yeah. Published it fall 2021.
Perfect. You guys must have had like the crystal ball or the 8-ball, right?
I will tell you, never in my career has a paper been published in a more timely fashion. It is almost consistent in the world of finance that you publish a paper and fall flat on your face with whatever you're talking about. But man, 2022 could not have been more perfect for what we laid out in the paper, which was pure luck. I would like to say I had some foresight and vision, but it was just pure luck.
Well, no, I think, obviously luck plays, it's that luck versus skill thing that Michael Mauboussin talks about. So, yeah, we're going to jump into this paper that you wrote called Return Stacking. Again, probably one of the best timings I've ever seen with a paper. And I want to dive right into it. I think where we start off with, Corey, is kind of just the why behind the paper, right? Like, why did you guys and Resolve Asset Management decide to get together and write this paper where you guys just sit around a fire one day and we're like, drinking and saying, let's write a paper together? Or was there something else behind all of that?
Well, we probably were sitting around a fire drinking at some point. I'm not sure that's where the paper came from, but look, let's rewind the clock back to 2008. I'm a big believer that people's formative experiences in their career end up shaping how they think about the world. And 2008 was sort of the first big event of my career in finance. And what we saw coming out of 2008 was a growing appetite among the entire industry for alternatives.
Yeah.
And in particular, liquid alternatives, right? In the decade hence, you saw a big move among institutions towards things like private equity, private credit, all sorts of private alternatives. But for your mass affluent retail financial advisor, they were looking towards ETFs and mutual funds as a way to incorporate alternative diversifiers within their portfolio. I mean, I'm sure you remember the number of articles that were written about the death of the 60-40 post 2008.
Yes, absolutely.
And of course, as things go, it then proceeded to be the best possible decade for the 60-40 from a risk-adjusted return perspective, I think, ever in U.S. stock bond history, or at least good recorded data history. That's just the way things always go. But what you saw was there was an appetite for alternatives, and then there was a very frustrating experience in actually incorporating those alternatives. So product manufacturers met the need. You saw all sorts of interesting long-short strategies come out, hedge fund style replicators. Liquid alternatives became massively in vogue, call it 2012, 2013, and then went on to dramatically underperform your very basic vanilla passive 60-40.
Yeah.
A good friend of mine, Brian Portnoy, has a saying, which is diversification means always saying you're sorry. And I think advisors were saying nothing but sorry to their clients for selling out of stocks and bonds and in incorporating these opaque diversifiers. That was sort of the continued frustration of my career. At the firm that I manage, Newfound Research, we really focus on helping individuals and advisors introduce diversifying alternatives into their portfolio. We think diversifying alternatives ex ante are really important for managing risk. But ex post, they can be very frustrating if you go through a period where they're not really additive. And so, fast forward to post 2020, what we were trying to do was figure out a way that we could incorporate alternatives into an advisor's or individual's portfolio without necessarily having to sacrifice the core stock and bond exposure that they wanted. Right? Because really, that was the fundamental problem that people faced in the 2010s. Let's say they wanted to include something like managed futures. Well, to do so, they had to sell stocks and bonds.
Yeah.
And if managed futures then went on to have a very bad decade, not only did they get the performance of that asset class, which did poorly, but the double whammy was that it underperformed what they could have been invested in, right?
Right. Right.
And so the question we were sort of asking ourselves is there a way for us to have our cake and eat it too? And it's something that institutions had been doing for decades. So rewind the clock even further, PIMCO back in the 1980s launched this product called Stocks Plus.
Yes.
Stocks Plus is this idea that PIMCO said, well, we're really good at managing bonds. We think stocks are pretty efficient. So what if we manage this active bond portfolio and then use it as collateral to buy S&P 500 futures?
Yep.
And what that effectively does, ignoring some nuances, is it gives you the return of the bonds, and then it gives you the return of the S&P 500 layered on top, minus the cost of borrowing that it takes to get that leverage on top. They called it Stocks Plus. The idea snowballed. It took 20 years to get fully in vogue, but institutions adopted it like crazy in the early 2010s in a concept called portable alpha.
Yes.
Where they said, hey, if we're just buying beta like the S&P 500, we don't need to invest $1 to buy the stocks. We can buy derivatives. We can use futures and swaps and all sorts of interesting derivatives to get that exposure, and then take the actual cash and invest it in hedge funds that can deliver alpha. And so institutions have been doing this for the last 20 years. It's not something that individuals or advisors were easily able to do unless they were willing to manage their own derivative positions until a few years ago, when you started to see that concept, that packaged concept of giving you one or two assets levered up, get put together in either a mutual fund or an ETF. Right. And in doing so, what that allows you to do as an individual is think about allocating capital to those levered products to free up room in your portfolio, to maintain the same core exposure that you want, but free up real estate in your portfolio that you can then allocate to diversifiers, with the net effect being you maintain that core stock bond profile that you really want, and the alternatives ultimately get layered on top. And so that's what we called return stacking, because it's ultimately this idea of stacking a second layer of returns on top of your core allocation. And it's something we're really excited and passionate about because it's a 40-year-old idea that's finally possible. And we think it truly unlocks the potential benefits of diversification for sort of the mass affluent.
So there was I think a change in the code or the SEC, like with these products. Is that correct, or is it just that the investment providers decided this is like the next bandwagon, so to say, or what happened?
I think a little of column A, a little of column B.
Okay.
So I will pat myself on the back here and stroke my own ego and say there was a roundtable. Barron's had a roundtable in 2017 talking about what's next for ETFs. And I said, look, the constant institutional belief right now is that we're entering a decade of low expected returns. And I don't think another weird thematic ETF is the way someone's going to meet their financial goals. To me, the next frontier of ETFs is this idea of capital efficiency. Don't give me a 60-40. Give me a 60-40 that's levered up 1.5 times. Call it a 90-60. Because then I can take, if I have $100 in my portfolio, I can put $66 in that levered 60/40. And what it effectively does is because it's a 90/60 and I put 2/3 of my money in it, well, I got the exposure of a 60/40 with
40.
just 2/3 of my portfolio. But now I've got 1/3 left over that I can invest in something that either helps enhance the diversification profile of my portfolio or potentially helps enhance the returns, both of which can help me potentially achieve my financial goals with a higher probability. So I said that in a Barron's roundtable. A lot of that was driven by conversations that were happening on Twitter. Weirdly enough, Twitter is this like interesting hotbed of communication and discussion for financial professionals. There's two anonymous accounts. One Econompic is their handle. The other was Non-Related Sense. Unfortunately, has since passed away.
Yes.
But dialogues with them sort of spurred this idea. I said it in Barron's, and Jeremy Schwartz at Wisdom Tree said, "This is a great idea." And kudos to him, breathed life into it and launched this levered 60/40 ETF. And
Yes.
so you have suddenly, right, the product has come to market. Now, you mentioned a really interesting point, which is, okay, this new derivatives rule. So it may come as a surprise to some people, but when you talk about putting a product or a strategy into a mutual fund or an ETF, it is highly regulated. And when I say come as a surprise, that's like, of course, right? It's highly regulated, but with the exception that there were never really very clear rules around the amount of leverage that the SEC was okay with.
Okay.
Right. So if I, for example, let's say I'm running a long short equity strategy and I go long, some stocks with my portfolio and I go short an equal amount of stocks. Well, how much leverage is that? Technically, there's like 200% gross, but it all nets out in exposure to zero.
Right.
And what happens if I want, to lever up both sides because I want more vol? If I'm running a managed futures product, how long can I go? How short can I go? It was never truly clear. And so what you had was a lot of product sponsors and sort of erring on the side of caution, where they said, we're not going to go overboard with the amount of leverage we could use because we don't want the SEC to slap us on the wrist. And ultimately what that meant, in my opinion, was a lot of uninteresting products, because for a lot of these alternatives, you do need leverage to make them interesting. Fast forward to actually, I think it was earlier this year, the SEC unveiled what they were calling their 18F4 derivatives rule, which gave I won't bore everyone with the details, but it gave very explicit
guidance,
yes, on how much leverage you could ultimately use in this framework. And so now you're starting to see products come to market. Like we just saw the launch of a product from a firm called Simplify, with this levered 2-year U.S. Treasury futures ETF that I believe has over 500% notional exposure to 2-year U.S. Treasury. So what that means is for every dollar you give them, they're giving you, I think it's something like $5.50 of 2-year U.S. Treasury futures exposure. I don't think that same product they would have been comfortable launching under the old regime, but under the new guidance, they can. And so suddenly, I think the floodgates have opened that you're going to see a lot more product like that, which again, from a capital efficiency standpoint, means that an investor can do a lot more interesting things with their portfolio without explicitly having to manage that leverage themselves.
So that this idea, it sounds like you've had for years at this point, right? It was just the implementation that kind of got in the way until most recently. Is that fair to say?
Yeah, I think I started writing about this idea back in 2017.
Okay.
And it really, there were some products out there like Pimco, for example, who I mentioned had that Stocks Plus program. Well, that was available to institutions. They then did launch some mutual funds around the concept. Never really took off. I'm not sure why, but in the grand scheme of things, if you were an advisor who wanted to run an ETF only portfolio for your clients, you really couldn't implement this idea in any meaningful way. You could do it it would look very weird. I'm sure your compliance department would throw all sorts of red flags about the products you were using. It
Right.
would never really stick. But now there have been enough products that have come to market that you, I think, can develop really interesting total portfolio solutions in either a pure ETF product or an ETF and mutual fund combined portfolio.
Very good. So, getting down into nuts and bolts, I know you kind of touched on it before, but let's just say, as an example, to be a little bit more clear, I have $100, Corey. I give you the $100. How am I implementing this return stacking strategy that you guys talk about?
Yeah, so I think it's always easiest to think of like a very simple example, and then
Yeah.
we can broaden out from there. So again, let's go to this pioneering product that Wisdom Tree launched.
Okay.
Their levered 60/40. So when you give them $1 and buy this ETF, they are giving you $1.50 of a 60/40. So what does that mean? Well, if you give me $100 and you want me to invest it, one of the things I could do, and you said, hey, I want to maintain core allocation to a 60/40. That's really important to me. One of the things I could do is I could take 66 of those dollars and put it in this strategy, this ETF, right? Because if I take 66 and I multiply it by 1.5, I get $100,
Right.
right? And so that means 66 in this levered 60/40 gets me $100 of a 60/40 with only using $66 of your capital.
Right.
And then it's a question of what do I do with the other 33, right?
Gotcha. Yep.
And the paper, this is where we talked about all sorts of different things. We tried to not make the paper very prescriptive. We wanted to say, hey, we want to introduce this idea. Here's a couple of options. I will tell you that our fundamental bias is that stock bond portfolio is fundamentally weak against inflationary shocks. That both stocks and bonds are susceptible to that risk. It's not something we really had to deal with as US investors for the last 30 or 40 years. 2022 has been the glaring exception of that. And so what we said is you really, if you want to have a well-diversified portfolio, you probably want to have a third leg of the stool that incorporates some way of managing inflation risk.
Inflation risk.
I think the obvious thing most people turn to, depending on their view, is commodities.
Yeah.
Or gold, right? It's sort of harken back to the permanent portfolio or Ray Dalio's all-weather approach.
Yeah.
You know, my view here, and again, this is my personal view, is that commodities can be very tough to stick with during those disinflationary environments. You go back to the 2010s, if you ran a 60/40 portfolio and smashed some commodities in there, well, those commodities were down 50% over the decade.
Yeah.
And I don't care how good an advisor you are. That's really tough to say to your clients, like, oh, just stick with me. It's only been 7 years of massively underperforming that 60/40 benchmark, that your friends all allocate to. But don't worry, these commodities will pay us back someday. Like, that gets really hard to do. So our preference has been tilted towards managed future strategies. Now, managed future strategies they were historically sort of in the hedge fund category in that 2010 sweep that we talked about into liquid alternatives where they were packaging up these concepts. They became available in mutual fund and ETF wrappers. And what they do is they trade global futures markets. So these are commodities, things you probably heard about, like oil futures and nat gas and lumber and all sorts of industrial products. But they also trade interest rates of countries around the world, US, Japan, Germany, the UK. They trade global equity indices, and they also trade currencies. Euro, yen, dollar. Depending upon the program, they can get there can be hundreds of contracts. There's now discussions among some of like the hedge fund programs talking about trading Apple markets in China. They get very niche. But your big ones are trading like your big industrial commodities that every nation in the globe is trading. And what they're ultimately trying to do, for the most part, is identify signals that will lead them either long or short those different markets to try to generate a profit. Historically, that's really been driven by trend following, which is just a really, like, the simple approach is if it's been going up, you buy it. If it's been going down, you sell it short, and you just hope that trend continues. And there's all sorts of narrative reasons why we think those trends emerge and why there's some alpha to that strategy. I'll leave that to a separate discussion, but
Sure.
ultimately what it means, what you see historically when you analyze the returns of these types of strategies, is that they're absolute return in nature, meaning they tend to never lose a lot of money, and they tend to be pretty resilient in almost all markets. So when you have a hyperinflationary market, well, they can go long commodities, they can short the appropriate currencies, they might go short rates based on what's happening, the central bank response function. You have a disinflationary environment, well, they might actually short commodities, they might go long rates. So they have that flexibility to adapt. Now, their weak point is those inflection points when you're having a regime change,
Yeah.
right? And they're positioned incorrectly. But right, we think that they make a great third leg of the stool. So a lot of what we've been focusing on is building out these strategic stock bond portfolios and using these capital efficient products to allow us to introduce diversifying alternatives like managed futures to help make the overall portfolio more resilient to inflation risk.
Right. So I know there's a lot of funds out there on that PIMCO thing. I think one of the issues they had is just like explaining it to advisors, to be honest with you.
I will tell you, if again, to pat ourselves on the back here, and I give Rodrigo all the credit in the world for coming up with the phrase return stacking.
Yeah.
I think sometimes just a rebranding, and that's not all return
Yeah.
stacking is. Like, return stacking to me is different than portable alpha. But PIMCO long explained that fund as you get the S&P 500 plus the alpha that we're generating in the bonds. And I think what they should have just pitched it at is you're getting bonds plus stocks, and so therefore you don't need to buy as much of either.
Yeah. Yeah.
Right.
I think there was just a disconnect on how they were marketing. To your point, like marketing was kind of lax on that. And I do remember I actually, followed that fund in 2008. They had a lot of trouble. And I remember talking to them, and they had a difficult time explaining exactly what happened. So that just kind of like put us away from it. But anyways, I digress. So going back to this, so you're saying, I have $100. I'm going to put $67 into this ETF that's going to give me the 60-40 exposure essentially. So in theory, I could have $100 in a 60-40 portfolio and $67 in this ETF, and I'm going to get the same return stream, same vol, et cetera, within reason, right? And then, but over here now, I have an extra $33 I can kind of go play with. And so now you're looking for different asset classes or investments that are, and correct me if I'm wrong, are fairly consistent in return, but then offer you some type of uncorrelated return when that 60-40 is not working properly, essentially.
Again, you can do whatever you want with that extra money. What I think you should do might be different than what you think you should do. I would say, for example, an idea I would not be a proponent of is taking that extra $33 and buying more equity exposure.
Sure.
Right? Because now you're a 93-40 and you've doubled down on the same risk. And so that leverage that you have in the portfolio is really going to hurt during an equity drawdown, which is eventually going to happen. And at some point is probably going to be a 50% drawdown.
Yeah.
Right? Ideally, what we're doing is we're adding something to the portfolio that will do well when stocks and bonds are down. That's sort of like the best thing we can do.
Yeah.
But that said, like, you could do stuff that is somewhat correlated but lower vol. So you could buy, as an example, really short-term, high-quality corporate bonds. And yes, credit risk is highly correlated to equity risk. Yes, you're going to have some interest rate risk in those short-term corporate bonds, but it's going to be such low duration that by putting $33 in it, there shouldn't be a tremendous doubling down of the same risk, and you can probably eke out some excess returns over a full market cycle. Again, it's not going to do a huge service to you from a portfolio resiliency perspective, but it's a very easy and I think obvious way to think about adding some incremental return. So there's all sorts of really fascinating things you can do with that freed up capital. I think it just sort of unlocks the potential of adding more diversification to your portfolio, but you do want to be careful you're not doubling down on the same risks.
So, I mean, at a basic level, you could just take that 33 and put it in like T-bills, basically, right?
Absolutely. If you put it in T-bills, you basically have a 60-40, right? And by the way, that isn't that ridiculous, because for some of the firms we talk to would be like a family office who will make investments in private companies or private funds, and they tend to receive cap calls, requests for capital, during market crises. So if
Right.
you have all this money invested in public equities, public bonds, and you have a bunch of money invested in private funds, and those private funds during March 2020 say, hey, there's all these great investment opportunities, we're doing a cap call, you need to send us $100,000. Well, now you got to liquidate your stocks and bonds to do that.
Right.
Where are you getting the cash from? Now you have this like settlement issue and it's operational. Well, what if on the other hand you said, we're just going to use a little bit of leverage to help us keep some extra cash on hand, so that when we get those cap calls, we can fund them more easily. And we don't have to sell what we're already holding. We just have the T-bills on hand. So that it sounds a little ridiculous to be like, you could do all this work and then just hold T-bills, which would give you the exact same return as just investing it all in a 60-40. But operationally, there are certain scenarios where that actually can make the burden easier.
Well, it gives you a ton of flexibility in that case, right? Like,
right.
Or even not even like a cap call, but big market downturn, I can then go, reallocate, capital to sectors of the market or investments that I think will be favorable going forward.
Yeah, you can use that cash to make tactical calls. We've spoken to firms that have done that, where they say they'll sit in cash and they see a big opportunity, they'll deploy it, and then they might tactically sell back out of it. Or let's say you have an individual who's taking withdrawals from their portfolio. It can just be a cash management tool. That's not really embracing the full concept of return stacking, but these capital efficient solutions can enable that sort of operational flexibility.
Excellent. So let's talk, one of the things when I read the paper that I was trying to figure out or understand a little bit more is like, we talked about, I give you $100, 67 goes towards this ETF, and then I've got this 33. How did you determine, I mean, I guess outside of, hey, I'm going to get this to 60-40 exposure, is there something else that might inform people that are trying to build these types of portfolios, like how much I should be allocating to this side of the ledger where I do have that leverage, and then the other side? Or is it always just like, hey, I want to have this balance, basically?
This is where things get very personal. My tolerance for a weird allocation in my personal account is probably much higher than someone who isn't as comfortable with alternatives, right? Some of the portfolios that we manage, for example, we will try to create that global stock bond core in different risk profiles. So it might be 20% stocks, 80% bonds, or it might be 80% stocks, 20% bonds. And we'll overlay that with about 15% exposure to managed futures. And it's my experience, and again, this is just my anecdotal experience, that is enough to make a difference, but not so much that it's going to make an advisor's end investor feel uncomfortable. Right. So let me walk you through a little math here.
Sure.
Let's say I'm able to replicate that global stock bond portfolio perfectly. So there's no tracking error. It's as if you had 100% of your portfolio there. And then I'm overlaying my managed futures product, and I'm giving you 15% allocation. Well, if that managed futures product has a, say, long-term volatility of 10%, what that means is I'm creating 1.5% tracking error, right? So 10% volatility of the product times a 15% position, 15% times 10% gets you to 1.5%. So the sort of tracking error around the benchmark, that extra volatility I'm creating of excess return is about 1.5%, which means in any given year, you're going to be within negative 4.5 to 4.5, but with a 99.9% confidence.
Right.
Right. And so it's enough to make a difference in a year like this. If you got a 60/40 and you're adding 4.5% returns because managed futures are screaming away, wow, you're not the hero. It's not like the portfolio's at, net zero here, but that's really additive over the long run. And then in your worst year, if you're underperforming by 4.5%, again, it's not like it's in the territory that it's going to blow you up.
Right.
So that's sort of the way I think about it. I think about that risk capacity, that risk tolerance. Now, someone like myself personally, I would prefer to dial that risk up to 30, 40% overlay. But a lot of the question is the thing that you're overlaying, how much belief do you have that it's going to ultimately diversify what you already own? And then second, how volatile is it? Because if I did 100% overlay of very short-term corporate bonds that have a vol of 2, well, that's almost the same risk as having a 15% overlay to managed futures with a vol of 10. Like they're from an attribution perspective, they're almost identical. So it's not an easy, like, what's the right number? It's what are you adding? How comfortable are you? And what's that ultimately going to introduce from sort of an excess risk into your portfolio?
So it sounds like the way to kind of look at it, if I'm trying to build out these different return stacking portfolios, is you're really trying to minimize tracking error somewhat, to a degree that the client's going to be, or the advisor is going to be comfortable with. So you can get to an 80/20 portfolio by using this framework, and build out, allocate however much you need to the levered products and whatnot. But what you're really trying to target is this tracking error measure, basically.
I think that's spot on, right? So first, the question is, can you get to that strategic allocation that the client wants?
Right.
Because again, that was the main frustration in the 2010s was I had a 60/40. The client would have been happy with the 60/40. And I sold 10% of my stocks and 5% of my bonds to build a 15% allocation to managed futures.
Yeah.
And then those managed futures underperformed stocks and bonds, and the client was mad at me for a decade.
Right.
Versus I'm able to maintain that 60/40 and I put the managed futures on top, right? And so then if you can do that, so the first step is what is the right allocation profile that gets the client to plan, makes them happy, that they're comfortable with strategically.
Yeah.
And then second is what do I want to layer on top? How much can I feasibly layer on top that isn't going to put the plan at risk ever, right? Because leverage does introduce a unique sort of characteristic of risk we can talk about. So it's not going to ever put the plan at risk, but isn't going to be so weird that the client can't stick with it.
Right. Yeah.
But it'll still have an impact. So I have found, like, I'll give you a perfect example. We run a model. I talked about the model that we do sort of a 15% overlay. We run another one that does a 60% overlay. High octane, right?
Yeah.
And what the behavior I see is that in the part of the year that managed futures was doing really well this year, everyone was looking at the 60% overlay.
Yeah.
And then managed futures had a bad go, and that overlay was like minus 500 basis points on the 60/40 return. And everyone went, ooh, that's a little too high octane for me. Let's go back to the one that's just a 15% overlay. And then managed futures did really well again, and everyone's eyes started to drift back. There's always this performance chasing that happens. I think, again, it's got to be the level that you are comfortable with as an investor or as an advisor, understanding the risk capacity and risk tolerance of your clients.
Yeah, I love that. I think, out of all the years I've been studying different ways, the biggest issue at the end of the day is tracking error, right? Like you could have a portfolio that, like value as a factor, right, was dead for 13, 14 years, whatever it was. But if you're a value investor, your clients would fire you because they just see everything else, their neighbor making a lot of money, et cetera. But I want to,
sorry to interrupt, but that you brought up something that is, right, to me, a huge question here when you talk about that tracking error. It's really about where are you spending your active risk budget? And people are traditionally used to, let's say you have a 60/40 portfolio, they are very used to spending some of that active risk budget in tilting their stocks. So instead of just buying the S&P 500, they might buy a value manager. And that is effectively, mathematically, It is the same as saying I'm going to buy a 60/40, and then I'm going to overlay that with a manager who buys all these value stocks and shorts the S&P 500. Because what they're that when they're and you're basically isolating their contribution through their active picks as a long short.
It's the
Right?
value factor, basically, essentially.
You've isolated the value factor.
Yes,
And
right.
so it's you get your benchmark and then you get this long short that you're overlaying.
Yeah.
And that active risk, but people are very comfortable with it when it's sort of masked in, oh, it's a long only manager picking stocks. It is the exact same mathematically as saying, nope, you got your benchmark and you bought a manager who's long short, long all the stocks they love, short the benchmark, which really isn't all that different than I've given you the benchmark and I'm going to overlay it with this, what I hope is a diversifying alternative. And
That's
so it's a question of, again, where do you want to spend your active risk budget? I think it's much more beneficial to maintain sort of vanilla stocks and bonds and overlay it with managed futures than it is to do stocks and bonds and then swap some stocks out to buy value.
Yes, that's a very good point. I've never thought of it that way, so I appreciate you bringing that up. With the leverage, let's talk about leverage, right? Sometimes a dirty word in the industry, I would imagine, or at least some of the stuff I've heard and read. So how are you determining? So I guess from my perspective, I'd be like, if I can free up $33 and do kind of whatever I want with it, within reason, obviously, why wouldn't I free up $50? Like, why wouldn't I just increase my leverage on this side a little bit and maybe buy like a 2-to-1 type of portfolio? Now I have $50. Am I structurally introducing more risk into the portfolio by doing that, or how do you view that, Corey?
Yeah, you are bringing up a really interesting question. So let's address the elephant in the room, which is leverage has been at the center of every major financial blow up in the history of finance.
Right.
The caveat I like to add there is that it is concentrated leverage that is at the center of every major financial blow up, not diversified leverage, right? Someone like Bridgewater's all-weather portfolio has been using leverage for decades, but they use it to introduce diversifying exposures, not double down on the same risk.
So I'm sorry but your earlier example of taking that 33 and buying equities again, basically with it.
Exactly. That's more doubling down on the same risk. And so that's where I would say that's where things get really risky. What happens when you say, I mean, let's just take that to an extreme. If the S&P goes up, stocks for the long run, right?
Yeah.
Why don't we just take all of our money and buy 2 times the S&P?
I love that question. I've had clients ask me, yeah, go ahead.
And my simple answer would be because at some point the S&P goes down 50%. And if you've levered up and it loses 50%, you've lost all your money.
Yeah.
Right.
Right.
And so we go, okay, maybe we don't want to be, 200%, but maybe the right number is actually 1.1, 1.2. And there is a trade-off. And you can think about this from a mathematical perspective. You can research something called Kelly betting that gets you to this, what we call the geometric, sort of maximum expected return, the maximizing your compound growth rate of the portfolio, that says there's actually this peak point where if you have that amount of leverage, that'll maximize your long-term growth of the portfolio. If you go any further, you're actually going to underperform because you've introduced too much risk.
Because of the drawdowns, basically.
Because of the drawdowns.
Yeah.
Once those drawdowns get magnified,
yeah,
that risk of compounding, right? You lose 50%, you need 100% to get back to break even, gets really painful.
Right.
But there's actually no real difference between taking a little too much leverage and too little leverage. When you look at it just objectively of how do I maximize my long-term returns, one is you didn't take enough risk. One is you took too much risk. Both of them underperform the optimal. Now, what happens in practice is no one knows what the optimal is. I can't tell you what the optimal amount of leverage is. So what we tend to do is you say, okay, historically, what would the optimal amount of leverage be? And then let's walk safely away from that to be less, right?
Yeah.
Because we never want it, because being too far is like a disastrous outcome where we blow up and don't recover. if we take too little risk, at least we're there to fight another day.
Yeah.
Right.
Yeah.
So what happens here is you say, okay, you agreed 200% bonds, 200% stocks is probably a bad idea, right?
Right.
But what if I said to you, okay, 50% stocks, 50% bonds? Would you lever that up 200%? 50% S&P 500, 50% Barclays Ag?
Possibly, because the theory would be that my bonds would counteract, on a correlation basis, they should move in the opposite direction. So
Yeah.
I'm gonna go ahead and say yes. Hopefully,
I mean, you would just maybe the argument is the portfolio has lower volatility, right? A 50-50 portfolio
right.
has lower vol than 100% equities. And so, maybe it's like half the vol, maybe a little less than half. So if you apply 200% leverage, now you're just sort of at the risk of equities.
Yes.
Okay,
Right.
that might be safe,
Sure.
right?
Yeah.
And so what you start to do is you play with this and you say, okay, well, now if I do stocks, bonds, and manage futures, and I start to build a portfolio, well, how much leverage can I sort of feel like I can safely get to? And a lot of it has to do with this expectation of I never want to get beyond a certain drawdown point with the amount of leverage I'm using, because that guarantees a blow up, right?
Gotcha.
And I want to be safely away from that. So
that's how you came up with the number, basically, is you were looking at the max drawdown in a levered position, essentially.
Yeah. So you look at that is one way if you are sort of unconstrained, right? If I'm running this as a hedge fund and I can buy all the underlying futures positions and use as much leverage as I want, that's sort of my constraining factor. When you start talking about return stacking in practice and the need to use ETFs and mutual funds to implement it, the constraining factor ultimately really ends up becoming what's actually achievable with the amount of leverage that's in the funds that you're buying.
Right.
And so you talk about this wisdom tree product, for example, NTSX. Well, if I put 100% of my money in it, I have a 1.5 times levered 60-40. It's a 90-60. Is that really... that's the most leverage I can achieve. Is that really a dangerous position? Probably not, right? Yeah. And then if I start to pare that back and now it's 2/3 of my money and I'm doing 1/3 stacking, well, unless I'm stacking equities and I get to a 90, I add I make it like a 90-40 with doubling down on the same risk. Even that, is that all that risky?
Right.
Probably not. It's hard to get yourself into a truly dangerous position because, again, the amount of leverage that's available in these vehicles is pretty constrained.
Could you maybe talk about how, I mean, you're not a representative of Wisdom Tree, but another way I could see people trying to implement this is possibly just, going back to the risk thing, is like buying those 2X ETFs.
Yeah.
Instead of, going with this kind of prepackaged thing. And I wanted to kind of pick your brain. This is a little bit separate from return stacking. Is like, those are daily observable things, but I've seen those things kind of get into, the return differences aren't exactly 2 to 1, right? So
right.
Maybe could you talk about that and maybe how that implementation might be different in what this Wisdom Tree product is?
Yeah, let's talk about those products, because those were the original levered products,
right?
That came to market. And you hit the nail on the head. They are daily reset, which means the goal of that product is to match, let's say it's a 2 times S&P, match the S&P return 2 to 1 every single day.
Right.
So if the market's up 1%, the product wants to be up 2%. The market's down 1%, it wants to be down 2%. And it needs to reset that every single day. Compare that to what would happen if I said, well, let's actually have a product that's levered 2 to 1 on a monthly basis.
Okay.
Well, what I would do is at the beginning of every month, I would borrow capital, right, to invest in the S&P. So I have 200% exposure. And then I would let that drift, right? And at the end of the month, I would more or less be guaranteed that I got 2 times the return of the S&P over the month.
Right.
Which is different than 2 times the return every single day because of the way compounding works.
Right. Yeah.
So again, we go back to the question of, okay, well, why wouldn't you necessarily want to do it on a monthly basis? Well, can the S&P lose 50% in a month? If it can, that product blows up.
Yeah.
So you never want to be, call it n times levered over a period that you think you could have a 1 over n drawdown. Right? Don't be 2 times levered over a period you think you can have a 50% drawdown. Don't be 3 times levered over a period you think you can have a 33% drawdown.
Right. Which actually happened, right? We had one of those products blow up like that.
Basically. Exactly. And so the reason a lot of these products reset daily is because that makes them very safe. I'm going to use air quotes. I don't know if people are just listening or watching. The safe in air quotes, right? It would be very hard for the S&P 500 to have a 50% drawdown in a day. Not saying it can't happen, but statistically, it seems pretty difficult, and you can sort of imagine the scenarios that would actually take. And so what happens is these products are safer for sponsors to launch, but because of that daily reset, they are going to drift away from a longer term multiple. So if you bought that January 1st and it's now December 31st and the market's up 10%, you will not be up 20%.
Right.
You are highly driven by the path of returns that occurs as to how close or far away you are from that 20%, because you're doubling that compounding every day. And in fact, there's this thing called variance drag that occurs.
Well, I was going to call it volatility drag. I think that's
volatility drag, variance drag, same thing.
Right.
Variance is just the square of volatility.
Right. Yeah.
Right. Which is basically the more volatility you have, the more it hurts your ability to compound.
Right.
Again, you have one big down day. Well, and it's now 2 times worse. Right. So let's say you had a 25% drawdown. Now it's a 50% drawdown.
Yeah.
Well, now you need, instead of
100%.
Now you need, instead of 33% gain to get back to break even, you need 100% gain.
Right, exactly.
And notice that 100% is not double the 33%.
Right. Yeah.
Right. And that's the critical point. So these daily reset products are not intrinsically bad. You can use them to create capital efficiency. You just have to realize the way they're designed is going to introduce a path dependency to them. That means that you can't expect them to match the market over longer periods of time.
And so, yeah, that really, unless you can like to the T kind of manage the vol or like forecast the vol is what you're saying. I mean, if you had zero vol, then it would be basically 2 to 2 or 2 to 1.
Right. I think if you have zero vol, yes, it should match.
It should match in theory 2 to 1, right?
Yeah.
If you're using,
I'd have to think about that. On the spot, simple math never works for me.
You're a lot better than I am. So if you find it to be something different, let me know. So kind of getting back to return stacking. So I love the kind of the concept here, right? One of the things that Newfound, or I've heard you say multiple times is and I might butcher the saying, but it's like risk can't be destroyed. It can only be transformed. What is happening with that risk in this portfolio? Like, where do you see that kind of migrating to or showing its ugly head, so to say?
Right. So this is a quote that I certainly I've said for a very long time, but it is by no means like a quote unique to me. Right. This is just a repurposing of the first law of thermodynamics of energy can't be destroyed. Yeah, risk can't be destroyed. We just sort of package it up and pass it around as an industry, and everything's about trade-offs, right? So you can't just add leverage to your portfolio and there's only rainbows and puppies and unicorns and it's all upside, right? There's clearly you're introducing some sort of risk. So let's think of some obvious risks here. One, I'm effectively borrowing money to add this exposure to my portfolio. That's what leverage is, right? A mortgage is a type of leverage. This is a car loan is a type of leverage. People are very used to using leverage in their life. This is just a form of financial leverage. What happens if that thing I add goes down at the same time as the things I already own? Well, my drawdown gets a lot worse, right?
Right. Yep.
And this is why I'm saying you don't buy the stuff you already own. You don't double down on the same risk. But that doesn't mean that the thing I buy is necessarily going to have zero correlation to the things I own. It might. And so that is one risk. You're introducing the risk that, they ended up being more correlated in a certain market regime. They all lost money, and now my drawdown is deeper than it would have been had I not done this. I would argue over anyone's full lifetime, that's bound to happen at some point. It's just a question of, was it more accretive the rest of the time that it justifies the risk?
Right.
There's also sort of a path dependency that happens because of that drawdown, right? That you need to manage the rebalancing between these positions. And you will never get, if you're using 40 act vehicles, you won't ever get an explicit margin call, right? You will get you'll just have to rebalance your position, and you got to stay on top of rebalancing to make sure everything stays in line. The nice thing about using ETFs or mutual funds is this is a form of non-recourse leverage, that if, let's say, the fund is levered 10 to 1 and blows up, great. If you put in $1, the most you can lose is $1. Even if the fund has a huge amount of debt it now owes, you can't lose any more than $1. I'm gonna contrast that to what happened in the United Kingdom this year with their pension funds.
Yeah.
Right. Because again, this concept is not new, and institutions everywhere have been doing it. But what you saw with pension funds is they are. I'm gonna try to do this as simply as possible to not drag this conversation out for an hour. But they're highly sensitive to interest rate risk. They have a long dated obligation that they owe to their pensioners, which they effectively treat like a bond that they're short. They owe this payoff in the future. And so that liability from an accounting perspective goes up and down in value as interest rates change.
Sure.
So one of the things they do is they want to buy a whole bunch of bonds to offset that value change, to basically hedge their liability. Here's the problem. Let's say you owe $10 billion in 20 years, but you don't have $10 billion in cash. How do you hedge that liability? Well, you could use a bunch of leverage, right? And you could buy a bunch of bonds on leverage. And that's effectively what they did. They put their money in what were pooled vehicles. Think of it like a hedge fund. So you and I both manage pensions. We both put $100 in the hedge fund. That hedge fund levered up 10 to 1. And we're both happy because now for every dollar we put in, we get $10 of bond exposure. That helps us hedge our risk. Well, what happens when all of a sudden rates go up?
Yeah.
And that 10 to 1 fund within a 10% drawdown goes bankrupt.
Yeah.
You and I have lost our money, but the problem is it wasn't non-recourse. All of a sudden, those hedge funds are asking us for money, and you and I need to make cap calls as pensions. And I go, great, I've got a bunch of cash on hand. I'm going to submit my cash. And you go, actually, I'm bankrupt.
Yeah.
I don't have the cash. Well, the pooled vehicle now goes, we're bankrupt.
Right.
And I, as a pension, go, my hedge fell apart right when I needed it the most. And that's the path dependency risk that can happen with leverage. If you can't meet those cap calls, if you can't, the margin calls that happen, and hopefully they never happen, but if they were to happen, you have to be able to meet them. And so if you're using that leverage, say, to buy totally illiquid assets,
yeah,
and then you can't rebalance or you can't meet the margin call, that's how you blow yourself up. So you have to, there's a little bit of maintenance that goes on. But again, if you're doing this, again, let's use like the 60-40 example with the Wisdom Tree product. Basically, for us as end investors, we just need to make sure we're rebalancing between the funds. They're going to get out of whack, and then we just got to rebalance them back into the appropriate weights.
So you're known as the master of rebalance, right?
I'm known as the guy who's obsessed with rebalancing. I don't think it's a good thing.
So how would you look at that in this framework? Kind of touching on that real quick. Like,
yeah.
I mean, do I do what I traditionally do and, put guardrails, drift guardrails, and then that's where I'm going to hit the rebalance. I know you're not a super big fan of like interval rebalancing or anything like that.
So this is man, you've opened a can of worms. This podcast could go another 3 hours.
Well,
you're going to be asleep by the end of it. Look, I'll keep this very simple. Turns out rebalancing is a de facto market timing decision. Whenever the question of when is involved, it is a market timing decision, whether we mean it to be or not, whether we're trying to forecast the market or not. If you happen to rebalance exactly at the March lows of 2008 and then exactly at the March lows of 2020, man, did you dramatically outperform your peers?
Yes.
Right.
Right.
And that might have just been, hey, you have a schedule to rebalance every March.
Right.
Well, the guy who rebalanced every September got unlucky, and you got lucky that you rebalanced at the bottom of the crisis and reloaded on risk assets. That looked phenomenal for you, right? Doesn't always necessarily play out that way. So then the question is, how do you avoid that risk? rebalancing frequently is one way that helps bring down sort of the risk of rebalancing at the wrong time. I actually think drift guardrails are a great way to do it.
Okay.
You're always going to have an element of this. What I don't recommend, for example, is you rebalance once a year in December. You're just going to have, there's a huge amount of variance that can happen between your realized return and what could have happened had you rebalance at another point of the year. But, rebalancing monthly, rebalancing quarterly, it cuts way down on that potential introduction of luck, whether it's good or bad.
Right. Very good. And one last thing, Corey, on return stacking, the leverage, you touched on the interest rate spiking, right? Like, how do you think about that? Or is that something that advisors and investors should be concerned about? I don't know, Fed funds rate goes to 10%. Like, is that going to blow up my leverage that I'm introducing in the portfolio, basically?
Well, let's talk about an actual example, right? You and I were chatting about this before we started recording. So there's another ETF from Simplify called TYA.
Yeah.
Full disclosure, it's an ETF that I use in the model portfolios that I manage on behalf of advisors. And keeping life simple, let's just think of it as a 3 times levered intermediate term treasury fund.
Okay.
Right? So what does that mean? Well, let's say you wanted intermediate term treasury exposure, right? To make numbers easy. To make numbers easy for me, I'm just going to say $30.
Okay, all right.
Right? $30. You could buy $30 of intermediate term treasury bonds.
Yep.
Or you could buy $10 of this fund.
Because it's 3x, basically.
Because it's 3x.
Okay.
Exactly. So that 3x gives you, for the $10 you put in, you effectively get $30 of exposure. Now, if you were to look at the returns of intermediate term U.S. treasuries this year, let's say they're down 10%. That's rough. No, it's a lot rougher. That levered fund is now down 30%. Right? From a line item perspective, that looks really bad. By the way, I know for a fact that there are levered pension products that are down 90% this year.
Ouch.
Right? And now that sounds like it's irrecoverable. But let's actually think about what's happening from a dollar perspective, right? You have $30 in intermediate term treasuries, and they're down 10%. You lost $3.
Yep.
You have $10 in a levered, 3 times levered intermediate term treasury fund that's down 30%. Well, 30% of $10 is $3. In both cases, you lost $3.
Gotcha.
Right. And I think that is like the number one thing that I think scares people away from this is they see these levered funds and they say, wow, it is down a lot this year. That the PIMCO fund that we talked about earlier, Stocks Plus, that was crushing its competitors from 2010 through 2020 is now the bottom. It's like below the basement of the group. It is like digging its way into a deeper and deeper hole because it's levered 2 to 1, 100% stocks, 100% bonds. Right. And that's doing horribly this year. But if you only put 50% of your money in it on a dollar basis, it's the same exposure. It's the same loss. And so again, going back to that leverage, if I lost the same amount of dollars, again, I just need to rebalance. So my exposure proportionally to my portfolio gets back to where it's supposed to be.
Right. That's an excellent point, because I'm not putting 100% of my money in that levered product, basically. So at the end of the day, when I look at my balance sheet, I'm still down the same effect.
Yeah. And again, to keep it another very super simple example, you buy that Wisdom Tree product, NTSX is the ticker. It's 1.5 times levered to 60/40. You buy that with 2/3 of your money and put the other third in cash. That product is going to be down 1.5 times what a 60/40 is down this year. But because you only needed 2/3 of your money, right? You're going to be down the exact same amount as if you would put 100% of your money in VBINX, the Vanguard Balance 60/40 fund.
Yep.
Right?
Yeah.
But you just did it in a different way. You got the exposure in a different way. The funds, if you look at them in isolation, man, that looks like a big, ugly drawdown.
Yeah,
the
I was
amount
just
of
gonna say
dollars
that
you put in, it's the same.
the line item risk, where you're just showing like the percentage loss, right? Instead of
Exactly.
this happens actually with regular portfolios where you might have, I don't know, 5% to an equity fund or something that did horribly, and the client or the investor is just looking at, oh, that thing's down 25%.
Yeah.
It's like nothing of their portfolio, basically.
And line item risk is a very real thing
Right.
that when you deal with enough advisors, they will tell you, you know, if this thing is 5% and it has too much vol and there's a day that it's down 40%, like clients are going to balk at that. They're
Yeah.
going to have an issue. And so those are, not insurmountable challenges, but those are actually some of the challenges that come with return stacking, that these products are going to create more line item risk. And it's just going to have to be a game of education and communication.
Education and training, right? Like, yeah, you're going to have to really, um, I think the way you explained it was actually excellent. So, kudos to you. Well, we're getting up to the end of our time here, Corey. I don't want to hold you longer than I need to. Where can people find the paper or data? Where can they find you? Can you just talk about that real quick?
Yeah, absolutely. I appreciate the opportunity. So if they want to read the paper, they can go to returnstacking.com and they can
Okay.
download the paper. If they're looking for me, you can go to our website, thinknewfound.com, or just Google Newfound Research. Or if you're on Twitter, you can find me all too often tweeting at Hoffstein is my handle.
And YouTube, you're a YouTube star. Yeah.
Yes. Good friend of mine, Jason Buck, and I host a show. We attempt to do it weekly, a much more casual show about finance. It's called Pirates of Finance, and you can look us up on YouTube.
It's awesome. And then before I let you go, kind of, I guess personally, I ask all my guests, like, if there's something that you feel like has framed your investment thinking, whether it's a book, it's a person, it's a paper, would you say you have anything that kind of colors your perspective? You said earlier, we are creatures of whatever environment we kind of like grew into, right? So I'm always curious to hear other people's like coloring that's happening.
Yeah, the formative experiences, probably a little genetics as well. I skew much more towards the risk side of the equation than the pursuit of returns. Just I think it's my bias. But thinking about things that were, I talked about 2008, very formative of my career. During that time, I was going to graduate school, or 2009, I went to graduate school for a degree in financial engineering, which was all about building derivatives, pricing derivatives, structured products. Gave me a really keen insight, and that's where I really got this concrete idea that risk is never destroyed, it's just transformed. That's, to me, was really all of that financial engineering program was about, was identifying risk, extracting it, packaging it, pricing it, selling it off. That's what we do in finance. That's ultimately what our function is. So that was incredibly formative. And then from a book perspective, Taleb is no longer not like he's a well-known guy, Nassim Taleb. But I really think his book, Fooled by Randomness, for those who haven't read it, is something that is very eye-opening to all the randomness and luck and bad luck that happens in the world. And I think reading it made me just a little bit more humble about everything.
Yeah.
Right? There's just luck everywhere.
I love it. And lastly, what media is taking your attention, whether it's a book or book series or podcast or Hulu or whatever.
I'm going to lean down because I'm reading a book right now.
Oh,
it's called The Fish That Ate the Whale.
Wow. I've never heard of that.
And it is a fascinating story about bananas in the United States and early industrialization of the banana economy and these banana barons that none of us are really aware of. And it's just a tale that I'll start with it. The story begins with this immigrant who moved to America trying to overthrow a government in Central America so he could continue his banana farm.
I thought so. There's a podcast, and I'm not going to bore you with it. There's a podcast on NPR Throughline, and they talk about that entire story basically.
Yes,
now, I don't know how deep it is to this, but it's funny you bring that up. I listened to that podcast with my daughter, who's like 12 years old, and she thought it was the most fascinating thing ever. Like,
Yeah, I've been super into history lately. Another book I read was Bubble in the Sun. So I mentioned before we started, I moved to Florida
yeah,
as a northerner originally in the United States. I think I'm a little biased against Florida. Just that's my natural state of being.
yeah.
We're biased against anyone that's not New England. And so reading this book was all about the history of how Florida was made and how it contributed to the Great Depression and the bubble in real estate prices that occurred here. Very fascinating. And then the last one was it was called In a Bottle of Rum, obviously tying into the pirate theme, but it's all about the history of the United States through the context of rum, which was
Wow.
incredibly important in, the triangle slave trade, molasses, the Caribbean, all of it ties together. We often think now of bourbon being the quintessential American beverage, but really before prohibition, it was rum. Rum was everywhere. It was the drink you would get. And so it's the history of the United States told through rum, which is it was just fascinating.
Excellent, excellent. Thanks again for your time, Corey. Great topic. I love the timing of it. To your point, though, it's probably a lot of luck, but I'm going to give you more credit. You guys did very good on that. So thanks again for the time, Corey.
Thank you so much for having me. Real pleasure.